So, welcome everyone. Thanks for joining us. As always, in 12 and a half minutes, we will see the release of the US Core CPI data as well as the US CPI data. You can see right here also the chart, how both indicators have been developing during the course of 12 months, as well as the forecast, the previous data. So what we can actually say when it comes to the CPI. Well, inflation has been low and fallen for the past 2 years. U.S. consumer prices remain unchanged in November, helped by declines in gasoline and natural gas prices. Some analysts expected a 0.1% rise. The low inflation, including October's reading of minus 0.1%, does not go hand in hand with the general signs of improvement in the U.S. market. Meanwhile, core CPI edged up 0.2% after increasing 0.1%. You can see that right here, right? And that happened in October, posting the third consecutive increase, averaging 1.7% over the past 12 months, a bit lower than the Fed's 2% inflation target. And some of the concerns now for the Fed is that persistently low inflation has allowed the Federal Reserve to pursue its extraordinary stimulus program. The Fed launched 85 billion US dollars a month bond purchase program in September 2012 in an effort to keep interest rates low and spur more borrowing and spending. Fed policymakers could continue their purchases for longer if inflation does not move closer to their 2% targets. Fed officials have said ultra-low inflation poses economic risks. Among other concerns, it makes inflation-adjusted interest rates higher, potentially discouraging borrowing. And if we look at some of the forecasts, what we're actually going to see today, let me pull up a couple of my other charts. Okay, there we go. So what you can see here, again, you can see the estimates for the US core CPI. As mentioned, it is 0.1%. Overall, 84 economists were surveyed, while for the US CPI data, 0.3%, 86 economists were surveyed. For example, if we have a look at some of the experts are saying, we could mention that Michael Carey, North American chief economist at Credit Agricole, he said, we forecast the top-line consumer price index likely rose 0.3%, which is in line with the overall consensus, alongside a softer 0.1% month-on-month in the core CPI. Again, this is also something in line with the market consensus. What he has also mentioned is that retail gasoline prices rose 1.1% between CPI reference weeks. Seasonal factors will amplify this as they anticipate declining gasoline prices during December. And so a strong energy index is expected to be responsible for most of the top line increase. Consumer food price inflation has been limited since the past summer, and agricultural prices suggest a continuation of this trend. Okay, now these were just some of the fundamentals that we wanted to share with you today. And to move on forward, I would now like to welcome Thomas to the whiteboard, who is going to discuss the potential positive impact of the upcoming data release of the US CPI on the US dollar.
Let me put myself on the whiteboard. So as you mentioned, I will be talking about possible positive impact of the data, and for that I chose New Zealand dollar, United States dollar. And let me, until my screen sharing loads, let me briefly explain why. So what are you seeing on the whiteboard is New Zealand dollar, United States dollar 1 minute chart. First of all, so why I chose this currency pair? Because of current market sentiment, which is strongly bearish. So if the data comes out better than expected, United States dollar appreciates and New Zealand dollar, United States dollar trails lower. So strongly bearish sentiment of 74% speaks in favor of such development. Also 57% of pending orders in 50 pips range around the current market price are set to, I'm sorry, there is a typo, are set to go short as well. In addition to this, New Zealand dollar itself is sold in 75% of the cases across the board, whereas United States dollar bought in 53% of cases across the board. So it also speaks rather well about the overall attitude and overall consensus towards the possible developments. And what is important in our opinion, the fact that one of the other market participants, Wanda, its customers and overall the institution itself actually reports that in New Zealand dollar, United States dollar case, market sentiment is equally divided perfectly evenly divided between the long and short traders, which strengthens the idea that we should see a rather strong reaction, rather substantial volatility during the release of the data. Now, if we look into the technical indicators, what they are suggesting, what is going to happen, you can see that no technical indicators do not predict any major turnarounds in the developments but is strongly in favor of the fact that the pair is likely to maintain its bearish trend. It also speaks rather well in favor of possible positive impact trading strategy. Now about the strategy itself, first of all, it had to be revised slightly before the start of the webinar, as you can see of this mild, well, I can't say mild because it was only 6 ticks, but in the minute chart sense, it was rather substantial of this sell-off right over here. And also you can see that, let me zoom in, that the pair actually has formed a channel down pattern with above the average quality and rather decent magnitude, and you can see that the recent bounce from the daily low, which is now actually would be located right over here, also coincides with the boundaries of the pattern. So we'll see how it works out, but I'm still in favor of the bearish breakout in such case. Now the strategy itself, of course, will current to buy at the current market price, to set stop loss at the 0.8305. It is a rather arbitrary level, which has to be chosen, as I mentioned, due to this sell-off right over here, and is mainly caused due to the fact that the pair stayed around it and was supported by it some 10 to 15 minutes before this sell-off, and it seems that sell-off itself was initiated on this level. Now for the take profit, the suggestion is to focus on the 100-day simple moving average weekly pivot point around 0.82794, which at the moment is located 21 below the current market price. Minor targets could be located, let's say short-term target, very short-term target could be located at the daily S2, which is located at 0.8293. So just to recap, select market, expected positive data from the United States, stop loss 4 pips above the current market price at 0.8305, which is a rather arbitrary level due to the developments before this sell-off 10 minutes ago, and take profit short term at the daily S2, and let's say medium term at the 100-day simple moving average weekly pivot point. So yeah, that being said, I will just put a screenshot on the whiteboard, close my screen share, and with 3 minutes left till the release of the data, I give floor to my colleague Alexander to continue with his presentation.
As you can see from my slides, I will be speaking about the negative surprise trading strategy, which is based on United States dollar and Japanese yen currency pair. In case we'll see some worse than expected data, CPI data from the United States, then the greenback will have great potential to depreciate, and actually that will also signal that the Federal Reserve was somehow a little bit more optimistic in their assessment of the current situation in the economy. So That also means that Bernanke can provide some dovish comments later today, and greenback will depreciate even further. However, speaking about the CPI data, the potential negative surprise trading strategy once again is based on United States dollar and Japanese yen, with the entrance point and the market price, which is currently 104.55, right at the level of 4-hour S3. The potential take profit could be placed around weekly pivot at 104.37, and that will be just almost 19 pips from the market price, while the potential stop loss is placed at daily resistance at 104.82, which is almost 25 pips from the market price. Speaking about the market sentiment, as you can see, vast majority of traders are holding long positions on the pair, Dukascopy traders, while wonder traders are almost opening long and short positions in the same percentage, as just 50.27% of all open positions are long. Meanwhile, Saxo Bank traders are also strongly bearish on the pair, expecting greenback to lose some ground versus the Japanese yen. So, all in all, we can say that vast majority of traders among free brokers are opening short positions, and therefore the short-term outlook is bearish for the pair. Now, speaking about the CCI index, as you can see, both currencies are bought. However, greenback has bought in just 53% of all cases across the board, while investors are buying Japanese yen in almost 57% of all cases. And obviously, the long-term outlook for the pair is bullish, taking into account strong depreciation of the Japanese yen. And therefore, 60% of pending orders in the 100 pips range are placed to buy the pair. And while the pair is appreciating slightly before the news release, okay. Well, you can still have a look at technical indicators. So the data actually came already, and the CPI fell to 0.1% last month, compared with 0.2 gain a month earlier. Initial jobless claims came at 326K, so that's a drop of 4,000 from the previous week. So actually, it was quite some portion of mixed data. However, the greenback is depreciating, and the initial market reaction is 15 pips, and the pair is approaching stop loss, which is placed just 12 pips from the market price. And let's have a look what's happening with the Kiwi and greenback. Obviously, the initial reaction was strongly bullish, and the pair has breached the potential stop loss. And the pair has already breached 4-hour pivot and is trading at 83.07, while the United States dollar Japanese yen is still trading around 4-hour support at 103.53. So while nothing special is happening, actually, as you can see from this table, technical indicators in the short term are sending either neutral or sell signals, meaning that in the nearest future the pair can still depreciate, while in the longer term, as I already said, the outlook for the pair is bullish. And one more thing, which I guess is worth saying, is that United States dollar and Japanese yen has been trading in boundaries of the ascending triangle since middle of December. However, on January 10th, the pair breached pattern support and has recently moved back in pattern's boundaries, so performed something similar to a fallback, meaning that soon we can see a sharp drop in the pair. And from the perspective of technical analysis, the short-term outlook is bearish once again, while in the longer term, the pair is still expected to appreciate. And once again, the initial market reaction is not really impressive, as the pair has fallen just 15 pips. and it's still fluctuating around 4 hours support at 104.51. Yeah, so I guess that will be all from my side, and thank you for your attention, and back to you.
Thank you guys very much for providing your technical analysis. And now we are going to get back to Dr. Dow's